Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500, and we're just going to be providing a general outlook as we go into the end of the year. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. Now, for reference, back in July, we suspected there would be a seasonal correction with the S&P 500. Before I go any further, after making that statement, I want to say one thing. When it comes to seasonality, which is something that a lot of people talk about, right? When it comes to seasonality, it can often play out how seasonality typically does, but there are some times where it doesn't, okay? So back in the summer, we suggested there would be a 5 to 10% correction in the S&P, and because of seasonality of pre-election years, and it worked out, right? And no one, of course, is complaining about that. But every once in a while, you talk about seasonality, and it doesn't play out, okay? That doesn't mean that seasonality is not important. It just means that there can be other factors that sometimes take precedence, right? So we have to remember that, right? We have to remember that. And back in the summer, we said that there would likely be a seasonal correction by the S&P in August and September, and then it would knock Bitcoin below its bull market support band, and that happened. Now the the S&P continued down. Of course, Bitcoin got a pretty big bounce, and the dominance of Bitcoin has gone up, which is what we suggested was the most likely scenario this year, and we've been correct on that. But the seasonality of Bitcoin in September did not play out like it normally does, okay? So we must always remind ourselves that when we discuss seasonality, it often works out, right? Like maybe 70% of the time, but there are instances where it doesn't. And so we take seasonality into account, but it's not everything. We also have to take other things into account as well. And so as we discuss ongoing seasonality and what it favors, we have to remind ourselves there are other things that can affect the market besides just simple seasonality, okay? So that's sort of I wanted to make sure that we're all on the same page there. So again, back in July, we suggested there would be a seasonal correction in the S&P 500. Now, why did we say that? Did we just say randomly, hey, the S&P's gone up a lot, it needs to have a correction? No, it was not based on that at all. In fact, what it was based on was just simply looking at prior pre-election years. Here's 2019, and saying, you know what, there tends to be a correction around this time. Here's 2015, right? There tends to be some type of correction, in, I don't know, in Q3 of the pre-election year. Here's 2011, and the stock market just kind of doesn't do as well in August, September, October of pre-election years. And rather than sort of individually compare every single one, we can add all prior pre-election year averages going back to the late 1920s. And we saw that we were sort of up here where it normally tops out, or at least a local top, in the summer. And we were looking at this and saying, well, normally the S&P is only up, 12% at this point, and this time the S&P was up 20%, right? So because of that, and because of seasonality, we suggested that the most likely outcome over the next few months was to get a sizable correction in the S&P 500. That has come and gone. Now, why did the S&P 500 correct? You could just say seasonality, although I think it has something to, something more to do than just that. In fact, this correction by the S&P has actually gone well below where the S&P is at normally at this time, right? You can see that it overshot where the prior pre-election year average is. One of the reasons for that is, in my opinion, is because the long end of the yield curve went up so much in a very short period of time. If you watched over the last month or two, especially on days where like the 10-year and the 30-year were going up, the stock market was going down. And I think the reason is because as the long end of the yield curve goes higher, it puts pressure on risk assets because it puts pressure on companies. The cost of capital is more expensive. And if the cost of capital is more expensive, then that can affect the bottom line. It can affect earnings. It can affect forward earnings for those companies. And therefore that can affect the stock market, right? The issue, of course, though, It's sort of like a negative feedback loop, right? If the stock market goes down, and because of that, and then that can lead to layoffs because those companies are trying to cut costs to keep their earnings up. So, and of course, if it gets bad enough, it can lead to a recession, right? So, when we think about seasonality, we have to remember there are things that can take us out of season of what normally happens at that time of the year. I mean, for instance, like if you were to go back and look at 2019, you'll see that August was red, but September and October were green, right? But this time, I mean, it was just 3 red months in a row. Red August, red September, red October. 3 red in a row. There's really been no relief for the bulls. Not since July, in fact. In fact, this move here completely wiped away all of the gains that the bulls had over the summer. So all of that exuberance from those stock market gains got completely wiped out over the last 3 months, right? So where does seasonality say we typically go in pre-election years after you get into November? Because we just had the monthly close. Well, what you'll see normally is that the stock market tends to sort of bounce around for, about, a few weeks, doesn't really go anywhere. And then on average, it gets a nice little push in sort of at the very end of the year. If you were to look at just a couple of examples, right? Like if you were to look at 2019, you can see that it was even more pronounced. If you look at 2015, we got a bounce, but then it really didn't go anywhere for the rest of the year. And we had a recession scare then, by the way. And then if you look at 2011, you can see that it had a bounce over here. But again, it really didn't go anywhere for the rest of the year. But right now, there's a lot of people out talking about, an end of year rally, right? An end of year rally. And if you were to look at monthly returns of the S&P, November does tend to be a pretty good month, right? I mean, in 2020, the S&P went up 10.75% in November, which of course is far beyond what it normally does. In 2022, it went up 5% in November, but there still are times where it doesn't, right? And in 2021, you can see it dropped 1%. So just because it's normally green does not mean that it has to be green. But if seasonality prevails, then that is why a lot of the bulls are thinking that there will be an end of year rally, because what they're doing is they're saying seasonality will prevail and the economy is strong and it can withstand higher interest rates. Okay, that's what they're betting on. And I'm not saying it's wrong. Like that could be right. That could be the correct view to have. But there's also other things we should consider as well. In addition to seasonality, we should consider if interest rates, if the long end of the yield curve stays elevated, right? If it stays elevated, I mean, look at this, right? Like the 10-year, if it stays elevated, will that affect the company's bottom line, right? Will it affect earnings? And if so, if the market is starting to sniff out that the Fed has gone too high in terms of their interest rates and the long end of the yield curve has gone too high and it's a burden on the U.S. economy, then it could throw seasonality out the window. Post-election years tend to be really good years, but it's not like 2001 was a good year, right? Because we had a recession. So you have to remember that there's always the seasonality, but there's always the other side of it too, where you could have something, sort of play out that takes it out of that. It's sort of like with Bitcoin, right? I mean, normally it goes down in September. Normally there's a correction. But this year, there's been a lot of hype around the spot ETF. I also think there's a lot of liquidity flowing from altcoins to Bitcoin in lieu of this, spot ETF. And so sometimes, the seasonality doesn't play out. And we have to consider that. So we'll try to do a good job of talking about seasonality, but also talking about other things to consider as well. So from a seasonal standpoint, on average, what we've noticed is that the stock market, on average, tends to sort of chop around through the end of the year, right? Chop around. It can get a push higher in December. November tends to, it can move higher, but it tends to still not really go anywhere. And then it sort of gets that final push at the very end of the year. And so that's what we should be looking for is, does that happen? Or does the S&P keep putting in lower highs and lower lows? There's two ways you can look at this, right? The larger view is this is a low, and this is a higher low, and a higher low, and potentially this ends up being a higher low as well. The shorter term view is this is still a low and then a lower high, right? You have lower highs and lower lows on shorter time frames. Okay? So at some point, this will, whenever this bounces, does it take out the prior high? The last several bounces have not, right? So like this bounce did not take out this prior high. This high was at 4,600. Then this high was at like 4,500, and then this high was at like 4,400. So if we do get a bounce, does it end up putting in a lower high at like 4,200 or 4,300? The bull market support band is rolling over, and that's where the S&P 500 was rejected in mid-October. So that will be something that the S&P has to wrestle with as well. It's also below its 200-day moving average, which is currently coming in at 42.42. So that will be another level that the S&P has to sort of wrestle with. And at times it respects it, and at times it doesn't. Right? Sometimes it tends to sort of respect that 200-day moving average, whether it's sort of holding it as resistance or bouncing off of it. Right? And then other times it doesn't really seem to pay as much attention. So that one is coming in just above where we currently are. So on any bounces, the thing to look for is, does the S&P take out 4,400? Does it take out the prior local high? If it does, then that makes a better case for an end of year rally, right, going into December, if it can take out this high. If on the other hand, if it can't take out that high, then it sort of raises the question, well, are the long and variable lags of monetary policy from all these interest rate hikes that we've had over the last couple of years, are they starting to finally catch up to the U.S. economy? And if they are, then you can throw seasonality out the window, right? And then you sort of start to usher in a recession. And it's like, and again, I mean, at this point, the labor market remains resilient. You still have an unemployment rate of 3.8%. Initial claims are still printing 200K weekly. I think the one concerning thing that I'm looking at with regards to the labor market is continued claims are starting to spike back up again, just like they did last September. So if this continues, perhaps this is another reason why the stock market has had a pretty aggressive sell-off is continued claims are starting to go up. And what that tells us is that it basically says that people that have been laid off are having a harder and harder time finding a new job, which is why continued claims are going higher, even though initial claims have if anything, have gone down. If anything, have gone down since the summer. Okay, so while initial claims have gone down, continued claims have continued going higher, suggesting that the people that are getting laid off are having a harder time finding a new job. Okay, so when you think back to like 2015 and what happened over there, there wasn't really a great move in the S&P 500 at the end of the year, right? It sort of just fell apart, and there was a recession scare. Last cycle over here, we had a great end of year rally, and then we got a recession in early 2020. Of course, people call it a black swan, which is fine. I'm not trying to say that it's not, but in both cases, you had sort of that recession or recession scare. Okay, you had one or the other, right? One or the other. And I know the no landing scenario is still a popular theory, and the soft landing scenario is still a popular theory, but we still have to contend with, there is a chance here that all these interest rates that came out so quickly will likely at some point start to have an effect on the U.S. economy. And when it does have an effect, then that would likely be seen in earnings of all these corporations, right? So when they start reporting earnings and they're continuing to miss, that could be kind of a sign that the Fed has gone too far and they're starting to have very, very negative impacts on the U.S. economy. And if that's the case, then that's where those companies will lay workers off. And if we get a recession, then that's where, again, seasonality is out the window. So that's just kind of how I'm playing this. I mean, it's not really that complicated. We called for this correction, and it happened, right? We called for this correction, and it happened. At this point, I think that we should respect some form of the seasonality to see if there's a bounce. But if we can't take out any of these, if we can't take out any of these lower highs, right? Like if we can't take these things out, then it would sort of suggest to me that all the long and variable lags of monetary policy are finally starting to catch up. And then we're going to go into the end of the year and early next year wondering when the Fed's going to start cutting rates to sort of come rescue the economy if something like that were to happen. So that's what I'm looking for. The correction we called for played out, and now we'll see what happens in terms of any seasonality coming in from November. So if there is a bounce, the key level to look for, I think, is 4,400. Does it get above that or not? And there's a chance it might not even get past the 200-day. So the 200-day is at 42.42. Some of the individual stocks are still looking a little sketch, to be completely honest, right? Like if you were to go look at some of them, like if you look at like Nvidia, it seems like it's starting to roll over here some. Google has taken a pretty big hit recently, right? Google has taken a pretty big hit recently. Meta, I mean, some of these have started to really roll over recently. But again, at this point, it still is not the worst thing in the world, right? I mean, but they are certainly starting to roll over. Tesla has has taken out this low over here. It's interesting because Tesla has only ever been putting in lower highs, even since November of 2021. There's just been nothing more than lower highs. Even this massive rally was still just a lower high at this point. It doesn't mean it can't turn into something else, but at this point, it's just been a lower high. So that's what we'll look for. That's what I'm looking for going into the end of the year. Is there any type of seasonal behavior by the S&P that can get us above this high? And if it can, it might mean that the U.S. economy still has some legs. If it can't get above 4,400, then I think we're probably looking into starting to price in a recession as we get into the very latter part of this year and perhaps the early phases of 2024. That's what I'm looking for. And we'll of course provide an update over the coming weeks, depending on how the S&P 500 plays out. There's a lot of important things coming up this week. Of course, we have FOMC tomorrow. We have a lot of jobs stuff coming out this week. So I mean, if the unemployment rate comes out on Friday and it's still 3.8%, then it's still not recession territory, right? If it comes out at 4%, then that's probably going to raise some eyebrows. If it comes in at 3.7%, then it likely just means that the Fed has all the reason to just hold rates higher for longer and to keep them there, keep them at elevated levels well into next year. So I'm under the assumption that the Fed will not pivot this year. The only way they would pivot is if there's some massive windfall event. Like if the S&P were to drop 20% before the end of the year, then yeah, like the Fed would probably pivot this year. But assuming there's no massive windfall event like that, then I think the most likely outcome is the Fed not pivoting this year, and perhaps the pivot would come sometime next year. But anyways, I think we'll wrap it up there. Thank you guys for tuning in. Hopefully this video was useful. Actually, there was one more chart I wanted to look at, and that was just the ROI of the S&P during various bear markets. Again, we don't know if the bear market is still going on or not. It's possible that this is the low, but also remember that if there's a recession, then recessions normally put in lower lows. If there's not a recession, then it would likely be a higher low. If there is a recession, then it'll likely be a lower low. And just comparing the S&P 500 to prior bear markets, you can see this is what it looks like compared to the financial crisis. Here's what it looks like compared to the dot-com crash. This is 1973 to 1974. This is the one that probably resembles it the most, 1946 to 1949. So there could be an example where the S&P puts in a new low, but it's only just barely a new low, and then goes up from there. Right? That's basically what happened in 1946 to 1949, which was, of course, coming out of a period of high inflation after World War II due to all the money printing. So I just wanted to show that chart. It does seem to be a chart that people like to take a look at. And so just to show you what it looks like compared to other bear markets, that's what you would look at. And then the last thing is to look at the ROI to low after yield curve inversion and to see that, look at this cycle compared to here's financial crisis, right? I mean, look how long the financial crisis just sort of went along, or that bear market, or sorry, not, this wasn't even a bear market until the top, of course, but just look how long it continued to go up, and then eventually it sort of folded over. Here's after the .com crash, and then here's some of these don't really have great data because it didn't really stay. Here's 1979 to 1980. Okay, so just a few different examples that I wanted to show you, and the reason that that's relevant is because if you were to go look at the yield curve or treasury yield spreads, we're getting pretty close to an uninversion. The 3-month and the 10-year we're seeing it getting pretty close to it uninverting, but not nearly as close to uninverting as the 2-year and the 10-year is right now. Okay, the 2-year and the 10-year are very close to uninverting. And if they do uninvert, I suppose it sort of raises the question, well, what normally happens when they uninvert? Back over here, when they uninverted, the S&P got a little bit of a pop to the upside for a month or two and then rolled over during the .com crash. Upon the uninversion, you can see it popped up a little bit, but it was a lower high, right? And then the market continued down. And then if you go back over here after the uninversion, which of course occurred right here, it looks like the market it went up a little bit and then down, then up, but then it went a lot further down and put in a new low, right? So that is another thing that can affect seasonality is, do you get yield curve uninversion? There are probably more examples than not of yield curve inversion leading to a short-term pop in the equity market, followed by it rolling over to a new low, 6 months later, 3 to 6 months later. So that's another thing that we'll have to talk about. But at this point, it's still not uninverted yet. And, while it's possible that it uninverts soon, it's also possible that it does something like this, like the 1970s, 1980s, where it comes close to uninverting and then just says, oh, just kidding. And then, sort of goes back the other way. So I would take a look at that as well. So you got seasonality, you have yield curve on inversion, you have ROI in bear markets, you have ROI after, upon yield curve inversion, etc. A lot of things to think about. Thank you guys for tuning in. We'll wrap it up there. I'll see you guys next time. Bye.